Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing PNC stock so we can determine if it's a buy or a sell. PNC is a bank and financial services company. Its banks can be found in 27 states plus the District of Columbia. They have over 2,600 branches and over 9,500 ATMs. They also offer financial services such as asset management, wealth management, estate planning, loan servicing, and much more. PNC stands for Pittsburgh National Corporation, and that's where they're headquartered in Pittsburgh, Pennsylvania. The company was founded in 1845. Let's get started with the model. This is a large cap company, 48 billion market cap. They're trading at $119 a share, and they have 400 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. In 2019, their free cash flow was $7.4 billion. In 2020, it dropped to $4.7 billion. 2021 came right back up there to $7.2 billion. And then it jumped up a lot in 2022 to over $9 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that has a similar trend as free cash flow. It was $5.4 billion, dropping in 2020 to $3 billion. Then in 2021, it's right back up to where it was in 2019, actually a little higher, $5.7 billion. Then it jumped up a little bit to $6.1 billion. Their revenue in 2019 was $18 billion. $17 billion in 2020, then jumped way up to over $19 billion in 2021, then over $21 billion in 2022. Let's go through their first quarter 2023 press release. PNC reports first quarter 2023 net income of $1.7 billion, $4 diluted EPS. Diluted EPS is earnings per share, and the shares outstanding they use is assuming all the convertible securities converted to equity. Revenue of $5.6 billion in the first quarter, which is a little lower than last quarter, but higher than the first quarter of 2022. Non-interest expense, this includes the payroll for the bank teller, the rent payments they pay for their banks, and a bunch of other things. That was $3.3 billion. Their pre-tax earnings was $2.3 billion. Provision for credit losses, $235 million. This is how much money they expect not to receive on their loan payments. Provisions are funds that are set aside for future losses. Let's say they loan 100 people $1 million each, so $100 million of loans. Maybe 5% of the people won't pay back their loans, so they report a provision loss of $5 million. But it is possible all 100 people pay their loans and they don't need those provision losses, so they pass through a gain on the income statement. Let's say 10 people don't pay their loans instead of the 5 they thought wouldn't pay. They put aside $5 million for losses, but actually had $10 million of losses, so now they have to add another $5 million. So they pass through a $5 million loss onto the income statement. Net income of $1.7 billion. Higher than last quarter and the first quarter of 2022. Diluted EPS of $3.98. Shares outstanding 402 million. They're lowering their shares outstanding. Last quarter was 404 million. Last year was 420 million. So it looks like they're buying back stock. And that's always a good sign when you see that. Book value per share is $105. So that means each share of common stock has a claim of $105 from their balance sheet. If you want to be more conservative and do the tangible book value, it's $77. That means we strip out intangible assets like goodwill and patents and trademarks. So each shareholder's tangible claim of the balance sheet is $77. As of the first quarter, they loaned out $326 billion and they have $436 billion of deposits. This is how a lot of banks get in trouble, is if they loan more money than their deposits. But it looks like they have a pretty good cushion. It was even better last year when they had less loans and more deposits, even more of a cushion. Accumulated other comprehensive income are the unrealized losses. They have $9 billion of unrealized losses. These may be hedging contracts that they have outstanding. And once those contracts expire, they're going to pass through a loss of $9.1 billion. It's like if you paid $10,000 for a bunch of shares of a stock, and now your $10,000 is worth $9,000, you have an unrealized loss of $1,000. Net loan charge-offs of $195 million. These are the loans that are owed to the company that are likely to not be received. They have a 1.7% allowance for credit losses. So they're saying they're unlikely to receive 1.7% of their loans. The company says they have a strong balance sheet positioning. Average deposits increased 0.3%. Spot deposits grew 0.5 billion. Average loans increased 1%. Spot loans increased $500 million. Allowance for credit losses is stable at 1.7%. Net loan charge-offs declined. It declined from last quarter, but it increased from the first quarter of 2022. Accumulated other comprehensive income improved 1.1 billion or 10%. That's quarter over quarter, but year over year, it got much worse. Tangible book value increased 7%. Common equity tier 1 capital ratio increased to 9.2%. ROE is a lot higher than previous quarters, 16%. Last year was 11.5%. Return on assets 1.2. That's net income over assets. That's also improving. Net interest margin 2.84. Net interest margin is really important for banks. This is the interest spread between the amount deposited and the amount they loan out. That's lower than last quarter, but a lot higher than last year. When the net interest margin is positive, that means the bank is operating effectively. Non-interest income to total revenue 36, efficiency 59. An example of non-interest income are bank fees. Their efficiency ratio has improved. It's now 59%. It was 68% last year. To calculate this ratio, you divide a bank's expenses by net revenues. In this quarter, they spent 59 cents for every dollar earned. And a lower efficiency ratio is preferable. It indicates they're spending less to generate every dollar of income. An efficiency rate of 50 or under is ideal. They're not quite there yet, but they are improving. It was 68 last year, now it's 59. Let's look at the next page of their press release. The income statement highlights comparing first quarter 2023 to fourth quarter 2022. Net income of 1.7 billion, increasing 146 million or 9%. Revenue of 5.6 billion, decreasing 160 million or 3%. This is due to lower net interest income and non-interest income. Net interest income of 3.6 billion, decreasing 99 million or 3%, driven by 2 fewer days in the quarter and higher funding costs, partially offset by higher yields on interest earning assets. Net interest margin of 2.84% decreased 8 basis points as higher yields on interest earning assets were more than offset by increased funding costs. Non-interest income of 2 billion decreased 61 million or 3%. Fee income of 1.8 billion decreased 72 million or 4% and included lower merger and acquisition advisory activity as well as lower consumer transaction volumes. So you can see non-interest income are all the fees they charge. Other non-interest income of 258 million increased 11 million or 4%. Non-interest income expense of 3.3 billion decreased 153 million or 4%, reflecting strong expense control. So they're doing a better job at managing expenses. Provision for credit losses of 235 million in the first quarter included the impact of updated economic assumptions, as well as changes in portfolio composition and quality. The fourth quarter of 2022 included a provision for credit losses of 408 million. The effective tax rate was 17.2% for the first quarter and 17.7% in the fourth quarter of 2022. Let's talk about their balance sheet highlights. Average loans of 326 billion increased 3.6 billion or 1%. And that's mainly driven by consumer and commercial loans during the fourth quarter of 2022. Loans at 3/31/2023 increased $500 million. Average commercial loans of $225 billion increased $3 billion, driven by growth in PNC's corporate banking business during 4Q 2022. Average consumer loans of $101 billion grew $600 million, and that included higher residential mortgage and home equity loans. Credit quality performance. Delinquencies of $1.3 billion decreased $164 million, or 11%, as a result of lower consumer and commercial loan delinquencies. Total non-performing loans of $2 billion. Net loan charge-offs of $195 million decreased $29 million, or 13%, due to lower consumer commercial net charge-offs. The allowance for credit losses of $5.4 billion was stable. The allowance for credit losses to total loans was 1.66%, compared to 1.67%. Average deposits of $436 billion increased $1.3 billion, or 0.3%. So that's good to see that deposits are going up. People are not scared to put their money at PNC. I can't say the same thing for all banks, especially with those really big bank defaults a few months ago. Average investment securities of $143 billion, that was stable. Federal Reserve balances of $34 billion increased $3.5 billion, driven by higher borrowed funds and deposits. Because the way a bank makes money is people deposit into their checking or savings account. The bank takes that money and loans it out to people. So they may pay you 1% to deposit your money at their bank, and then they loan the money out to somebody and charge 8, 10, 12%. They make money on the interest spread. But sometimes banks need more money than what's deposited with them, so they go to the Federal Reserve and borrow from them. They borrowed $34 billion. Let's take a look at some of their financial results. The first quarter of 2023, fourth quarter of 2022, and first quarter of 2022. So their revenue sources are net interest income. That's the interest spread I just explained to you. That was $3.6 billion. And non-interest income. A big non-interest income is their fees. That was $2 billion. So total revenue, $5.6 billion. That is down from last quarter of $5.8 billion, up from $4.7 billion. Provision for credit losses. So they have to post money for potential future losses, $235 million. It looks like they had a gain in this category because they posted too much in the past, and they didn't need those provisions. Remember the example I explained earlier? If the bank lent $1 million to 100 people, how they handle credit losses? Then you have non-interest expense, $3.3 billion. Examples of this are payroll for their employees, the utility bills at the banks. So their income before taxes is $2 billion. That is up when you compare it to these two quarters. Income taxes of $350 million, net income of $1.7 billion. They spent $68 million of preferred stock dividends, net income to common shareholders. So if you're watching this video, you might be a common shareholder. That's $1.6 billion, up from these two quarters. They have strong EPS of $3.98, 51 cents higher than last quarter, 75 cents higher than the quarter of last year. They paid out $1.50 in dividends. Their effective tax rate is lowest at 17.2%. Their net interest margin is 2.8%, a lot better than last year. The higher the net interest margin, the more efficiently the bank is using its money. It was better last quarter at 2.9%. 36% of their revenue comes from non-interest income, like fees. Efficiency of 59%, so that is improving. It was much higher last year at 68%. ROE of 16%, that looks much better than prior quarters. ROA of 1.2%, that is better than prior quarters also. That's net income over assets. That's how well a company uses its assets to generate a profit. The next slide is their balance sheet. Assets of $562 billion. That is higher than prior quarters. They loaned out $326 billion. $4.7 billion allowance for losses. If you have a savings account at PNC, you're part of this $34 billion of interest earning deposits. That's a lot lower than last year of $49 billion, but it is higher than last quarter of $27 billion. Investment securities of $138 billion. Total deposits $437 billion. Remember earlier I said sometimes they borrow money. Sometimes a bank needs more money than what's deposited with them. Of the $61 billion of borrowed funds, $32 billion of that is from the government, $20 billion from senior debt, lower ranking debt of $5.6 billion, so they have to pay higher interest rates on this lower ranking debt, and then other $3.6 billion. They borrowed more than double last year's number of $27 billion. Shareholders' equity is $49 billion. That's assets minus liabilities. And the reason common shareholders' equity is different from total shareholders' equity because preferred shareholders also own part of the company. Their value is about $7.3 billion. So book value per share is 105. That's higher than last quarter, lower than last year. That's your claim of the balance sheet for each share you own. Tangible book value is 77. They have under 400 million shares outstanding. Last year, 415 million. Loans to deposits, 75%. That is worse than last year of 65%. But sometimes when banks go into default, this number is like 100%. You don't want to be that high. The ideal loan to deposit ratio is 80 to 90%. 100% is really risky. Even though they're higher than last year, 75% is fine. That's really how banks make money, is by using your cash, paying you a low interest rate, and then loaning that out and charging a higher interest rate. Discretionary client assets under management, $177 billion. This is when you give your money to PNC and let them make the financial decisions. You let them invest it for you. Non-discretionary is when you have the final approval on the investment, but PNC cannot invest any money until you approve it. Then brokerage accounts, $77 billion. This is when you control all your money. Nobody else can see it or invest it. Their non-performing loans is better than last year, 62 basis points. Last year was 78 basis points. But it's a little higher than last quarter of 61 basis points. Loans that are currently delinquent are $1.3 billion. That is down a lot from the prior quarters. It appears that credit standards are more restrictive. Their book value per common share is 105. That is up from last quarter, down from last year. Tangible book value per share is 77. The way you calculate tangible book value, you take your equity of $42 billion, you take your common equity, you minus goodwill and other intangibles, $11.4 billion. That gives you $30.7 billion, and you divide it by the shares outstanding, 399 million. A really good way to value a bank or insurance company is look at their tangible book value. Let's look at the capital structure. $49 billion of equity, $59 billion of debt. They have 46% equity, 54% debt. Their net debt is $24 billion, so they have $35 billion of cash on their balance sheet. I give them a WACC of 10.3%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $86 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $85 billion. We divide that by 400 million shares. And we get a calculated stock price of $213. They're trading at $119, so they're trading at a 44% discount. It's a strong buy according to the model. Simply Wall Street is really close to me. They're at $212. They say the stock is 44% undervalued. 12 analysts price this stock, and the average price target is $144. The low is $120. The high is $186. Another 21 analysts price this stock, and the average price target is $144. They say it's 21% undervalued. This is where the stock has been trading since '95. So it looks like it was about $20 back in '95. And then by 2001, it ran up to $75. Then the dot-com crash, and over the next 2 years, it came down to $35. And then over the next 6 or 7 years, the stock price went up, hitting about $85. Then it fell down to about $20 at its low during the Great Recession. Then over the next 9 years, it really ran up to about $165. When COVID hit, it came back down to below $100. Then over the next year, it blew up to its highest ever at $225. It's down 50% since the high, sitting around $120. But they always pay a dividend, as you can see. They pay a quarterly dividend that they increase pretty much every year. It's currently at $1.50 per share. That's a yield of 5%, 26% of their free cash flow, 39% of their net income. There are 337 regional banks, and they're the largest of those 337. Their debt to equity ratio is worse than the median and average. They're at 1.2. They pay a really good dividend, higher than the median and average. They generate lots of free cash flow. They're the largest on this list in terms of market cap, a little larger than US Bank. Their price to book is a little worse than the median and average. Price to book is market cap over equity. Their PE is a little worse than the median, better than the average. That's market cap over net income. Their price to free cash flow is a lot better than the average, a little better than the median. That's market cap over free cash flow. Their price to sales is better than the average, equal to the median. That's market cap over revenue. They generate a ton of revenue, $21 billion. Third most on this list. US Bank is the most, then Truist. Their 5-year annual revenue growth rate is only 6%. That's worse than the average and median. The most important stat to look at is price to book. And Truist is a lot better at 0.7. There's some at 0.6 here. But just because you have a really good price to book doesn't mean you have quality assets. So you also want to look at the assets as well. And their most important assets are their loans. Because when they loan money to someone, it's an asset on their balance sheet. To the person receiving the loan, that's debt. Let's go through their first quarter PowerPoint presentation slides. Strong first quarter 2023 results. Grew deposits, increased capital and liquidity, remained focused on disciplined loan growth, well-controlled expenses, generated positive operating leverage, maintained strong credit quality, continue to execute on our strategic priorities, return $1 billion of capital to shareholders through dividends and repurchases. Net income of $1.7 billion, EPS of $4, operating leverage of 2%, ROE of 16%, return on tangible equity of 22%. They loaned out $326 billion, up 1% from last quarter, up 12% from last year. They have $143 billion of investment securities, $46 billion of RMBS, residential mortgage-backed securities, $2.5 billion of CMBS, $7 billion of asset-backed securities, $37 billion of Treasury and government bonds, $95 billion of securities held to maturity. I'll show you the other $50 billion. $32 billion of agency RMBS. Agency is Fannie, Freddie, or Ginnie Mae. Non-agency of $700 million. So these are securities issued by another bank, maybe JP Morgan or Goldman Sachs. CMBS of $3 billion. $9 billion of Treasury and government securities. These are available for sale, $48 billion, so they could sell them at any time. They borrowed $33 billion from the Federal Reserve. They have $436 billion in customer deposits. They borrowed $63 billion, so their equity is $41 billion. They lent out $326 billion. The average yield, the average interest rate charge is 5.3%, which is up a lot from prior quarters because interest rates are getting higher. They took in $436 billion from customer deposits, and they pay 1.7%. Look how low it was last year, 0.04%. $121 billion of the $436 billion is non-interest bearing, so they do not pay an interest. Lots of banks do not pay interest on a checking account. They do on a savings account. They receive $3.6 billion of net interest income, $2 billion of non-interest income. So total revenue, $5.6 billion, down 3% from last quarter. Expenses of $3.3 billion. So their earnings are $2.3 billion. Net income of $1.7 billion, up 19% from last year, up 9% from last quarter. Revenue of $5.6 billion. $2 billion from non-interest income, $3.6 billion from net interest income. You can see their efficiency is getting better. It's down to 59%. They're able to manage expenses, only $3.3 billion of expenses against $5.6 billion of revenue. Last year they had $3.2 billion of expenses, a little less, but a lot less revenue. That's why they're more efficient now. The way to calculate this number, 59%, it's expenses over revenue. Efficiency improved to 59%, 2% positive operating leverage, revenue declined 3%, expenses declined 4%. Because the FDIC is nickel and diming the banks, They generated 15% of positive operating leverage, $2 billion of non-performing loans, up a bit from last quarter, but down when you compare to the 3 quarters before that. It's a decline of 13% compared to the first quarter of 2022. Delinquencies declined 22%, $1.7 billion to $1.3 billion. They have 20 million consumer accounts. The average person deposits $11,500 across 2,450 branches. 89% of their deposits are insured, meaning they're within the $250,000 FDIC threshold level. 11% is uninsured. They're beyond that $250,000. For their commercial business, 80% is uninsured, 20% insured, because they tend to have much bigger balances. They have 1.4 million commercial accounts, and those accounts have $207 billion in it, which is a little less than the consumer deposits. But there's 20 million consumer accounts versus 1.4 million commercial accounts. Their consumer balance went down from $233 billion to $230 billion. 90% of that $230 billion is interest-bearing, 10% non-interest-bearing. Commercial also declined from $217 billion to $207 billion. 55% interest-bearing, 45% non-interest-bearing. When you combine the two, it went down from $450 billion to $437 billion. 73% interest-bearing, 27% non-interest-bearing. They consistently have more non-interest-bearing accounts than the industry average. The industry average is currently 25%, and they're at 27%. They have a 35% deposit beta, and it was only 16% in the second quarter of 2022. Deposit beta measures the sensitivity of a bank's deposit cost to short-term interest rates. The higher the beta, the more sensitive expenses are to short-term interest rates, which is not ideal. They're forecasting their beta to go up to 42% by the end of the year. Another way to put it, the higher the beta, the more volatile expenses can be. They have $143 billion of security assets on their balance sheet. That provides them a yield of 2.5%. The duration of those securities, how long until they expire, is 4.3 years. 69% of the portfolio is held to maturity, which means assets they need to hold until they mature. They have $42 billion of fixed rate swaps, duration of 2.25 years. Here's the securities and swap runoff by quarter. Next quarter, 2% runs off, then 5%, 9%, 12%, 16%, 20%, and then 26% in the fourth quarter of next year. Most of that 26% is securities. About 1/3 is fixed swaps. AOCI, accumulated other comprehensive income. These are unrealized gains or losses from swaps or hedging agreements. They expect that to go down from $8.8 billion to $5.4 billion by 12/31/2024. Their liquidity coverage ratio is 108%. For the bank part of the business is 130%. Liquidity ratio is the amount of liquid assets the bank needs to hold to cover expenses. Ideally, a bank should have over 100% liquidity ratio, which they do, so they could cover their short-term cash outflows. If this was under 100%, then there's a higher risk of a bank default. It's not a guaranteed bank default, but the risk is higher. Borrowed funds as percent of total liabilities. It's currently 12% of total liabilities. It was as low as 6% in 2021, as high as 19% in 2014. They have a 9.2% capital ratio, higher than a requirement of 7.4%, but it's 7.5% if you include AOCI. Their cash balances at the Federal Reserve peaked above $85 billion. Their market value of equity increased substantially since 12/31/2021. Their commercial real estate portfolio, total loans $326 billion, non-office commercial real estate 8.3%, office commercial real estate 2.7%. So total CRE is $36 billion, which is 11% of their total loans. Multifamily is the biggest at $14 billion. Office is $9 billion. Industrial and warehouse $4 billion. Retail $2.8 billion. Their $8.9 billion office portfolio, 58% is multi-tenant, 16% single tenant, 14% medical companies, 10% government, and 2% other. And of that $8.9 billion, 44% is in suburban areas, 14% medical offices, and 29% central business districts. They have the most exposure in the DC area, 1.4 billion, then LA area, 1.1 billion, Dallas, $500 million. The average loan is 35 million. They keep 7.1% in reserves. So 7.1% of the 35 million they keep as a backup in case someone defaults. Their net charge-offs over average loans is 0.5%. Delinquencies is 0.2%. Non-performing loans 3.5%. Criticized loans 20%. When you hear criticized loans, these are borrowers who are currently paying on their loan, but there seems to be a decent chance they may not pay in the future. They have a strong balance sheet, 437 billion of deposits, 33 billion owed to the Fed, tangible book value of 77, net charge-offs 195 million. When you compare that to the last quarter, the fourth quarter of 2022, everything improved. So that's a good sign. Let's talk about their 2023 guidance. They expect period end loans to increase 1 to 3%, average loans 5 to 7%, revenue up 4 to 5%, non-interest expense up 2 to 3%, and effective tax rate pretty much flat. Let's look at their second quarter guidance compared to first quarter. They expect average loans to be stable, net interest income down 2 to 4%, fee income stable to down 1%. Their other non-interest income was 258 million. The projection is 200 to 250 million. Revenue down 3%, non-interest expense up 1 to 2%. Net charge-offs 200 to 250 million. So to summarize, I have them trading at a 44% discount. They've been around 178 years. So we looked at a lot of information, and it seems like they're doing a good job at running their business. They're not too leveraged. Their loan to deposits is only 75%, and they have a really big customer base. But let me know in the comments if I missed anything or if anything wasn't clear. I ranked their free cash flows 9 out of 10, their revenue 8 out of 10, their ratio 6 out of 10. So feel free to like, subscribe, or comment. Talk to you soon.